I'm Jesse Green. I'm Senior Fellow at the Richman Center, and I'm pleased to introduce the lecture today on tax policies at my work. The Richman Center promotes evidence-based public policy and fosters dialogue and debate on emerging policy questions where business and markets intersect with the law. Certainly today's topic involves both business and the law in complex and important ways, as our speakers will demonstrate. The topic of today is critical to our country's future and has been something we have been debating between our political parties for some time. What tax structure or structures will make the U.S. economy work and grow while providing the revenue we need to support desired government expenditures? Today we have three experts here to give us their views of what might work. Michael Graetz, to my right, is a leading expert on national and international tax law. He is Columbia alumni professor of tax law and William H. Friedman professor of tax law at the law school. Professor Graetz joined the Columbia faculty in the fall of 2009 after holding faculty positions at Yale Law School for nearly 25 years. He has written widely on federal taxation. He is the author of the leading law school coursebook, Federal Income Taxation, Principles and Policies, numerous other books on federal taxation, and more than 60 articles on taxes, international taxation, health policy, and social insurance issues. Before Yale, he was professor of law at the University of Southern California from 1979 to 1983. He started his teaching career as a law professor at the University of Virginia Law School from 1972 to 1979. Professor Graetz has held several positions in the federal government. He was assistant to the secretary and special counsel for the U.S. Department of the Treasury from January to June 1992, and he was deputy assistant secretary for tax policy at the United States Department of Treasury from January 1990 to December of 1991. He earned his BA from Emory University in 1966 and his LLB from the University of Virginia in 1969. Also with us today is Mihir Desai. He's the Mizuho Financial Group Professor of Finance, Senior Associate Dean for Planning and University Affairs, and the Chair of Doctoral Programs at Harvard Business School. His expertise and research interests include tax policy, public economics, and international finance. His work has emphasized the appropriate design of tax policy in a globalized setting, the links between corporate governance and taxation, and the internal capital markets of multinational firms. His research has been cited in The Economist, Business Week, the New York Times, and several other publications. He is also the author of International Finance, a casebook, which features his many case studies on international corporate finance. His academic publications have appeared in many leading economics, finance, and public economics journals. He is a research associate in the National Bureau of Economic Research's Public Economics and Corporate Finance Programs, and is the co-director of the NBER India program. He is also the advisor on the advisory board of the International Tax Policy Forum. He received his PhD in political economy from Harvard University, his MBA as a Baker Scholar from the Harvard Business School, and a bachelor's degree in history and economics from Brown University. In 1994, he was a Fulbright Scholar to India, which Desai's areas of expertise include tax policy, international finance, and corporate finance. To my very left is Andrew Stern. He is the Ronald O. Perlman Senior Fellow at the Richman Center at Columbia. He is the former president of the 2.2 million member Services Employee International Unit, the largest union of health care, hospital, nursing home, health care, janitors, security officers, child care, food service, state workers, and the fastest growing union in North America. He is a leading voice on major issues confronting American workers and the American economy as the United States confronts the challenges posed by the global revolution, the third economic revolution in world history. He's the author of A Country That Works, his 21st century ideas and practical solutions about restoring the American dream. Andy Stern was a presidential appointee to the National Commission on Fiscal Responsibility Reform, the famous Simpson Balls Commission, and a member of the Council on Foreign Relations U.S. Trade and Investment Policy Task Force. His name is frequently found on the short list of everything from Washington's most influential leaders on healthcare modern healthcare carries top 10 leaders, as well as Fortune and Washingtonian Magazine's top power player. He is a member of the board of the Broad Foundation, the Open Society Institute, and a lifetime trustee of the Aspen Institute, and a graduate of the University of Pennsylvania. Thank you all for joining us today. Appreciate it. Let me start by asking Michael Graetz to kick this off with a discussion of what we should do with our taxes. Thank you.
Thank you, Jesse, and thanks to the Richman Center for sponsoring this event. This is a particularly auspicious time to talk about tax reform. Not only are we in the midst of a presidential election with two candidates who have very different views about how our nation's tax system should be revised, but we also are approaching 2013, which will be the 100th anniversary of the 16th Amendment and of the modern income tax. It is also a year in which there are only two views about tax reform. Those who think something big should happen, and it will, and those who think something big should happen, and it won't. Everyone agrees that our current system is broken, that it's overly complex, that it causes too many unwise distortions in people's behavior, and that it could be made far more conducive to economic growth. Last year, 2011, was the 25th anniversary of the Tax Reform Act of 1986, the last major reform of the income tax, and legislation that many, including the, is it Simpson Balls or Bowles Simpson? I think it depends on who you're listening to, right? The Bowles-Simpson Commission suggested that we reprise the 86 Act, and Mitt Romney actually is also using it as a template for his tax reform proposals. That legislation in 1986 was surely the crowning domestic achievement of Ronald Reagan's presidency, and it was widely heralded as the most important tax legislation since the income tax was extended to the masses during World War II. And now pundits and politicians from across the political spectrum are calling for a replay. So it's worth taking a moment, I think, to review what happened then. The 1986 reform increased the permissible amount of tax-free income. It lowered and flattened tax rates. It shut down mass-marketed tax shelters for high-income individuals. It curtailed the ability to shift income to lower income, lower rate family members. And it taxed capital gains at the same rate as ordinary income. By shutting down tax shelters for individuals and repealing tax benefits for equipment and real estate, Congress was able to finance a reduction in the corporate rate from 46% to 34%, and to also pay for individual tax reductions. The corporate changes also made the corporate tax more neutral across industries, and the base broadening, rate reducing tax reforms of the U.S. were mimicked throughout OECD nations. But the changes that were wrought by the 86 Act have proved neither revolutionary nor stable. What ultimately moved the 1986 Act was an uneasy marriage of two very different agendas. The conventional tax reformers who were interested principally in improving tax equity by broadening the income tax base so that income would be taxed similarly, regardless of its source, joined together with supply-siders and deregulators who were interested principally in enacting lower tax rates to get the government off the people's backs. This proved to be an uneasy marriage, and the ink was hardly dry on the 86 Act before the divorce started. And by now, the divorce seems final. Thousands of pages of amendments to the tax code since 86 have narrowed the income tax base, and the top rate has crept back up. Even though deficits were becoming a problem by the mid-1980s, the linchpin of the 86 Act was revenue neutrality. by insisting that revenue neutrality was an imperative. The congressional leadership demanded that any amendments that were offered to the tax bill that cost money had to be offset by revenue raisers. Legislators behaved quite differently when, to pay Peter, they had to be explicit about how they planned to rob Paul. Tax reform was also distributionally neutral, so tax reform in 1986 was not the occasion for shifting the distribution of tax burden among income classes. So distributional neutrality and revenue neutrality were the guiding lights of the '86 Act. But conditions are very different today. First, it's not clear whether either revenue neutrality or distributional neutrality will be enough. Given the size of national debt and projected deficits and increases in debt that we expect, both in the near and in the long term, it may now be essential that tax reform produce additional revenues. And revenue increasing tax reform will be even more difficult politically. Second, given the rise in inequality, especially the increase in the share of income and wealth going to people at the very top, many of our political leaders are not willing to settle for distributional neutrality. They, and you should count President Obama among them, want to use tax reform as an occasion to make the federal tax system more progressive. Third, and more importantly, there is no pot of gold from which to finance tax reform. In 1986, as I said, benefits for plant and equipment, limitations on individual tax shelters, and taxing capital gains as ordinary income financed the rate reduction for individuals. But now, given the internationalization of economic activity during the past 25 years and the increasing competition from abroad, the 1986 Act's reliance on increased corporate taxes is not possible. Corporations and other owners of large amounts of capital now move money quickly and easily around the world, making it much more difficult for any nation, including the United States, to tax their income. We need to attract capital, to create better conditions for American workers and businesses, and in order to do that, America must be an attractive place for both domestic and foreign investments. If the substantive difficulties of designing sound corporate income tax policies for today's global economy were not hard enough, taking political considerations into account makes the task positively Herculean. Corporate income taxes are popular with the public, despite the virtually unanimous view among tax policy analysts that the corporate tax is a bad tax economically. It is child's play to characterize large corporations, particularly large multinational corporations, as villains. This is why the public seems to like a tax that economists hate. But high rates on corporate income in today's economy are a bad way to achieve either economic growth or to obtain more progressivity in the distribution of the tax burden. So the corporate tax now should not, and as a practical matter, will not, be able to finance tax cuts for individuals. Nor can tax reform be financed through additional borrowing. George W. Bush did that in 2001 and again in 2003, and it cannot be repeated today. In 2001, Alan Greenspan told the Congress that the budget surpluses of the federal government were so large that we would soon pay off all of our national debt and the federal government would have to invest in corporate stock, an idea he abhorred. The good news is that we've solved that problem. Our national debt is now larger as a share of our economy than any time since World War II, and then the debt was owed to Americans. Now more than half is owed to foreigners. So there is no pot of gold to finance tax reform unless it's hiding somewhere under a rainbow. People talk about broadening the tax base and lowering tax rates, but as the Romney-Ryan campaign has shown, they are reluctant to tell you what they mean by base broadening. So here is the ugly truth. The 1986 legislation did not induce Congress or presidents to forego the income tax as a blunt instrument to serve non-revenue raising purposes. Presidents and members of Congress from both political parties have continued to act as if an income tax exclusion, deduction, or credit is the best prescription for every ill facing the nation. In the process, the IRS is no longer just a tax collector, but is now also the administrator of many of the government's spending programs. To keep track of all the tax benefits, the federal budget each year contains a list of tax expenditures. The number of these tax expenditures has grown from 128 to 202 since 1986. And once enacted, they tend to stay in place. Their total cost in revenue is estimated to exceed $1 trillion a year. But here's the rub. These are not narrow special interest tax loopholes. Indeed, the biggest items are tax breaks widely available to broad segments of the general public. The largest tax expenditures are very popular. Tax advantages for employers' payments for health, insurance, and for retirement savings. Deductions for home mortgage interest and state and local taxes. Charitable contributions and low or zero rates on capital gains. No politician wants to admit it, but if tax reform is to be financed by broadening the income tax base, these are the tax breaks that will have to be eliminated or sharply curtailed. Sadly, I now regard the 86 Act as a promise failed. I do not believe that the best path for tax reform is simply to improve the income tax. Changes in the past 25 years make this, in my view, a dead end. As we now know, it does not take very long after a good cleansing of the income tax for it to get quite dirty again. Even those who applauded the 1986 Act as a successful tax reform must admit that the legislation was not stable. Many of its reforms have been reversed. Its broad base and low rates have been transformed into a narrower base with higher rates. And how can anyone remain optimistic today about fixing the income tax without more radical surgery? Today's tax reform challenge is daunting: to reduce deficits and debt in the long run, but also to promote our nation's economic growth. The fundamental problem is that in today's international economy, the United States can no longer afford to rely so heavily on income taxation to finance federal expenditures. What our nation needs is a better and new system, one that is far simpler, fair, and more conducive to economic growth. Compared to the rest of the world, the United States is a low-tax country, but we are not a low-income tax country. Our income tax takes the same share of economic output as does the income tax of other nations. The big difference is that we are the only OECD nation without a national level tax on sales of goods and services. Reforming the income tax will do nothing to change this fundamental economic disadvantage. We need to restructure our nation's tax system in order to compete in a global economy. It is quite practical to combine a tax on sales of goods and services with an income tax on higher income people, so that the system is at least as progressive as current law and raises at least as much revenue. This I have detailed in a book called 100 Million Unnecessary Returns, and the Nonpartisan Tax Policy Center has recently estimated my plan. And here is what they said. A value-added tax, a tax on goods and services, at a 12.3% rate could finance a $100,000 exemption from the income tax, removing more than 150 million Americans from the income tax rolls. Making this system revenue neutral with a distribution of the tax burden similar to current law could be accomplished with an income tax rate of 16% on income between $100,000 and $200,000, and a 25.5% rate on income above $200,000. It would also finance a 15% corporate tax rate and a debit card and payroll tax offsets that exempt low and moderate income people from the tax increase that the value-added tax might otherwise impose. Small businesses with up to $500,000 or even $1 million in sales could be exempt from the consumption tax. If you gear up for such a tax, it could take the IRS 2 years, it's estimated, up to 2 years, to be ready for that. And experience elsewhere shows that if Congress were to enact such a tax, that during that 2-year period, Americans would accelerate their purchases of large ticket items, such as cars and large appliances, providing a short-term boost to the U.S. economy. Over the longer term, such a tax reform would make the U.S. a much more favorable place for savings, investment, and economic growth. Most Americans would pay no income tax at all, no tax on their savings, and everyone would face a lower tax on their savings and investment. The vast majority of Americans would never have to deal with the IRS. The tax reform that I've described would also make the U.S. a much more favorable place for corporate investment. And it fits well with international tax and trade agreements. The system would solve the problem now caused by international tax planning by multinational corporations, and consistent with our obligations under trade treaties, it would tax imports and exempt exports, yielding hundreds of billions of dollars for the U.S. Treasury from sales of products made abroad. By returning the income tax to its pre-World War II role as a relatively small tax on a thin slice of high-income individuals, it would eliminate the temptation of Congress to use the income tax and tax breaks as if they are the solution to America's social and economic problems. We have tried that, and we know it doesn't work. The 1986 tax reform gave our income tax a good cleaning, but its ink had hardly dried before Congress started adding new tax breaks and raising rates. A replay, in my view, is simply inadequate to address our current economic and fiscal challenges. A dramatic reform that uses a goods and services tax to reduce our nation's reliance on income taxation could redeem the failed promise of the '86 Act. This time we need a major overhaul of our nation's tax system, not just an oil change and lubrication. Thank you.
When you're on a panel like this, it's hard to compete with the stature of Michael Graetz and Andy Stern, so stay seated. I will say that what I lack in gray hair, I do bring something unique to this panel, which I want to expound on a little bit, which is an economics perspective. As an economist, I think it's useful to ground our thinking about these things in some basic principles. So what I want to take you through is some of those basic principles, which echo much of what Michael talked about, and then talk about a specific reform that, in the absence of a grand reform, I think would be very, very useful. So the first couple of things I want to say are just the principles that should guide us. And so Michael's already outlined one major principle, which is the tax system serves to redistribute income and achieve equity goals that we all might agree on, sometimes disagree on. But it's a major instrument in that direction. But as economists, we tend to focus not just on equity, but in fact we tend to neglect it. We tend to focus much more on efficiency. And I want to just make clear that those efficiency grounds lead in certain directions. So first off, you might just, at a first pass, you might ask, well, what do you mean by efficiency? It's a straightforward concept. The notion is that high rates discourage activity of all kinds. I was kind of thinking about this earlier today. There's a blog post on The Atlantic, which tried to argue that effectively that research shows that tax rates don't affect economic growth. And it followed the analysis something like the following, which is, tax increases under Clinton, and we have booming years subsequent. QED tax rates don't influence economic growth. And I think that's a really disturbing conclusion. We know a great deal about how tax rates, and in particular the world we live in, of high tax nominal, high statutory rates, narrow bases discourage activity. And so we should take that as a cornerstone of thinking about tax reform. We should not neglect that as a cornerstone, which is we know behavioral responses are high on various margins. And that's true on investment, when people decide where to invest and how to invest. It's true on labor supply at the high end and even the low end. And it's true in various ways on where you locate activity. So I think the first principle to just anchor ourselves in is efficiency as one of the goals, not the only goal, but a very important goal of our tax system. That is going to take you in the direction that Michael has outlined at the end of his talk, which is towards a consumption tax. This is implicit in his rationale, but it's worthwhile making explicit. I'm going to say consumption tax, he said value-added tax. He says tomato, I say tomato. It's a version of the same thing. And the reason is that that is the broadest base that one can imagine that has the feature of not penalizing savings. And so that consumption tax intuition, I think, is a really important intuition. As Michael hints at, we stand almost alone as a country without such a national consumption tax. And there are many virtues to it. First, it enables us to consider broad bases with much lower rates. It enables us to think about eliminating avoidance in various ways that are considerably better than what we stand with today. So that cornerstone of efficiency, I think, is an important way to anchor our thinking about what meaningful tax reform is and how tax reforms that might work should be designed. And that's going to take you straight to a consumption tax. The second kind of cornerstone of your thinking, I think, should be that we no longer live in a world where U.S. tax policies dictate the way the rest of the world works. And that is a perhaps unsettling observation, but it is nonetheless true, and it's probably something you should feel happy about, which is people around the world are getting wealthier, and that's a good thing. The consequence of that is we look a little bit smaller, relatively speaking. But once you get over your consciousness of that relative argument, there's much to be happy about. That process of other countries getting richer and larger, and that process by which goods, people, capital, ideas move across borders faster than ever before, is the central fact of our age, and is something which has to guide tax reform. So first, efficiency, and second, an appreciation for how quickly things move in this world. And if one takes that as a cornerstone, one then becomes, I think it amplifies the previous logic, which is the way people respond will be even faster and harsher in a world where borders mean less and less. And that's going to be true for individual talent, that's going to be true for corporate investment, that's going to be true for where corporations domicile themselves. It's going to be true on all these markets. And there's a host of evidence that that's the case. So I think the second cornerstone to your thinking should be one where we have highly responsive people who are looking around the world to decide where to live, where to be citizens, and where to report their income, just on a planning basis. So that world, by the way, is going to take you, not a big surprise, again, in the direction of the consumption tax. Because, again, it's going to be something where people consume something in a certain location, and that's something where source is a meaningful idea. So that second principle is also going to take you in that direction, but it's also going to make you humble about raising rates in ways that are out of line with the rest of the world, which in some cases the U.S. system is today. Now, the third cornerstone I just want to lay out here and then talk about a specific reform should be that there's no free lunch. And that no free lunch happens in two directions, which is first, and Michael I think emphasized this appropriately, there is some bubbling intuition somewhere out there that if we just close those damn loopholes, we'd all be fine. And I think that intuition is completely wrong. And in fact, I think the loophole logic is the biggest kind of intellectual loophole there is, which is some idea that we can just seek out of this idea that we have serious fiscal choices ahead of us. And that's the furthest thing from the truth. So one, as Michael laid out, these things labeled loopholes are actually very significant policies that we have collectively decided to do. Now maybe they're not good ones, maybe they're bad ones, but we have significant policy debates to talk about. The second version of this no free lunch argument is the notion that we have significantly less tax revenue than we need. And that is just a reality. And so that idea that we can, in some sense, settle this without higher amounts of tax revenue, I think is faulty. And so whatever we choose to do, we're going to have to think about expanding the revenue base in some general direction. So those three principles, I think, are what should anchor your thinking about as you think about tax reforms that might work. And what I want to turn your direction now towards is a specific reform that I think would actually be the most likely and most productive reform that we could conceivably implement. And this is in the spirit of, I'm all for grand reforms, but increasingly I think it's, from my perspective, hard to see that happening in the next administration, given political constraints. And moreover, there are some areas, and the panel's topic is at least tax policies that might work. So let's try to talk about a reform that actually could actually happen in the next administration, whoever's in charge. And that would be reforming the corporate tax. Now, you might say that doesn't sound that exciting, so let me try to motivate why that would be quite so exciting. So the first thing to realize is there's actually considerable agreement about the corporate tax. So we've had initial proposals from both sides of the aisle, including Charlie Rangel and including Dave Camp, that have really significant reforms out there. So we actually have potential to actually get a real reform. No kind of drama of a great 86 type of reform or the Graetz plan, but a real possibility for something great. So that's number one. Number two, I think the reason to focus on the corporate tax is because A, it's so broken, but B, if you think about the central crisis today of productivity, arguably the productivity of the American worker, I think in the short run, can be best enhanced by significantly restructuring the corporate tax. And the reason for that is, as Michael alluded to, people think the corporate tax is borne by corporations. In fact, we know that's not the case. We know that it's borne by one of two sets of actors, maybe three actors, which is either labor, capital, or perhaps buyers of products. And the evidence would suggest that it's largely borne by labor, unsurprisingly, because capital is very mobile and products are in global markets. So we see the incidence of the corporate tax, meaning who really bears the burden of the corporate tax, to be labor. And unsurprisingly, that's going to turn down their productivity, and it's going to make for lower wages. So I think there's a reason to think about the corporate tax and changing it for that reason as well. If you think the central crisis today is competitiveness, and you think the central crisis today is productivity of the American worker, the corporate tax is one of the first places where you should look. So what should we do about it? So the first thing is just to do a little diagnosis, and then we can kind of think about what the right kind of plan is. So first off, diagnosis is we live in the worst of all worlds. And that world is a world in which both sides can claim the following. So one side can claim we have the highest corporate tax rates in the world. Somewhat true. Other side can claim we actually have some of the lowest corporate tax rates in the world. Also, in some way, true. And that is the sense in which we have the worst of all worlds, which is we have high statutory rates, and we have low to average in the OECD average rates, which is a way of saying we have a list rate that people look at as being very high, and you pay on the margin. And then, in fact, when you look at actual average tax rates, they're actually reasonably low for corporations. That's the worst of all worlds because you raise less revenue and you have all the worst incentives in place. And so that is the first thing that we have to really think about fixing. Now, the reasons for it are manifold, but one key reason is going to be when you have very high statutory rates, the incentives for planning are remarkable. And in fact, we see that all over the place. And you can turn to your favorite corporation and if you look deep into them, you may find, well, that they pay little to no federal income tax because they figured out ways to not do that. So the first piece is to figure out that problem, which is the worst of all worlds on high rates and low rates. The second thing to figure out is the international piece of the corporate tax used to be the tail on the dog, a small piece of global operations for multinational firms, and that no longer is true. So we run a very unique system in this country where we tax worldwide income of citizens, that includes you, but also our corporations. And that system, I think, is increasingly, out of step with the way the rest of the world thinks about this, which is they've moved to a setting where they actually only tax your income in your country, or resident-based taxation. And two, has various bad incentives. So you might have read recently about the cash hoards that corporations have on their balance sheet. Really remarkable. We have, let's say, $2+ trillion on corporate balance sheets. So mobilize that in some way, that would be comparable to any kind of stimulus, far bigger than any stimulus that we might politically, feasibly actually enact these days. And part of the reason that cash balance is there is because we run a system where we tax folks only when they bring back cash to the United States. So that's one of the many disincentives that we have in the current international provisions of corporate tax. So the second thing we have to fix is the international piece of this. The other reason to fix it, by the way, is those are some of the most profitable operations and the highest growth operations that our corporations have today. It is tempting to demonize those global operations and make them out to be something that does not serve American interests. So, for example, when a company invests abroad, it's tempting to think about that as lost American activity.
Here again, I think empirical evidence is not consistent with that belief. If anything, we see corporations succeeding abroad and also succeeding at home. The third piece of the thing that's broken is that we now have more business income in non-corporate form than we do in corporate form. Well, that's a way of saying that people have figured out that there are various intermediate organizational forms like LLCs, chapter S corporations, where now by and large people have figured out that's where you want business income. So again, we're having a narrow base and a high rate on effectively what is only large public corporations. So why we would want to have a full tax on large public corporations is not entirely clear. I think some of it should. The final piece of this that I think makes the corporate tax important is I think it's causing a little bit of a crisis in credibility for the tax system overall. There are repeated reports that are well researched that suggest that many corporations don't pay taxes. And in fact, they report large profits to capital markets, and they report no profits to the tax authorities. And that's a problem. And it's a problem that undercuts, I think, credibility in the tax system overall. So once, and again, you can think about your favorite high-tech company, and if you look a little deeply into them, you'll find that in fact, despite the proclamation that they do no evil, they figure out ways to do things, very sophisticated things, to avoid paying U.S. taxes. Again, that comes as no surprise with their high statutory rate and the incentives, in fact, to engage in that kind of activity. So these four pieces, I think, are critical for thinking about what a new corporate tax looks like. The four pieces being, getting rid of the worst of all worlds. Second, getting rid of international provisions, which I think are highly antiquated. Third, figuring out how we get these non-corporate business income back in the mix. And then fourth, rectifying this problem where corporations are able to report profits opportunistically to capital markets and opportunistically to tax authorities. I think the solution to that is in a corporate tax that first brings down the rate considerably. And in the spirit of DC talk, we should try to at least be somewhat revenue neutral and raise the same amount. The key is going to be, though, I think, to make sure that we do this in a way that captures all that non-corporate income. So if we try to be revenue neutral within the corporate sector, I think it's going to be very, very difficult to do that and to achieve anything that we want to achieve. So one has to broaden the net and think about all that non-corporate income, which is various types. It can be services income, it can be law firm, it can be a law firm income that I think we'll have to attack. The third piece is to really think hard about the international piece. And here I think we have to come to appreciate what the rest of the world has come to appreciate, which is that when you penalize the foreign operations of your firms, you likely do more harm than good. As tempting as it is to think that we should penalize that firm in some way or tax that firm in some way when they go abroad, because darn it, those are lost American jobs. That logic is likely wrong, very wrong in the following sense, which is when I think American firms succeed abroad, they succeed at home. And that logic shows up in the evidence, and is also, I think, fairly intuitive, which is one could have imagined the opposite. Which is, let's say we had in the early 1980s or early 1990s stopped a company like IBM from globalizing their operations around. Where would they be today? And the answer is they'd be a shell of where they are, which is a pretty vibrant company today, employing 100,000 people in the United States. So that logic, I think, is really critical. So we understand that when they expand abroad, we prosper. That's the logic which other countries have come to, major economic trading partners of ours, including the UK and Japan, and I think it's something that we have to come to. And the final piece is to rectify this ability, and this is in part in the Graetz plan as well, is to rectify the ability of corporations to announce their profits opportunistically, characterize them opportunistically, capital markets and tax authorities. And so this would be a way of trying to get to something that's in the business known as book tax conformity or alignment, which is a way of saying you can't report your profits differently to capital markets and tax authorities. That is disingenuous and creates too many opportunities for planning. It can also be a source of revenue for us. I think the feasible reform that is roughly revenue neutral within the business sector is one that brings down the rate quite dramatically to something like 18%, that captures a greater deal of income by looking at the non-corporate sector in a significant way, perhaps not at the same rate, that exempts foreign income so that we don't run a system which effectively penalizes firms when they invest abroad. And finally, provide some revenue by making sure that corporations are no longer allowed to report their profits in an opportunistic way to both capital markets and tax authorities. I think that's the kind of reform, if we're interested in the productivity of the American worker, which I think is the central issue of the day. Of course, it's tied into issues of equality, tied into other issues. If that's the central issue, I think that's the partial reform that actually allows for the most scope and actually is a feasible reform in a constrained political power.
So having just heard from probably two of the leading country's experts on taxes, it's kind of a daunting challenge for me, as someone who realized, when you heard their introductions, I think you heard all the different professorships, doctorships, prizes they've won. And so understanding my scholarly limitations, I'm going to do what you should always do when you're outgunned by people of substance, is you change the subject. So I'm going to talk about something a tiny bit different, which is why what was just said as a logical, feasible, thoughtful opportunity to change the corporate tax system in this country is completely not true, in the sense of political reality, not logic or viability. So let me just explain, when I think about taxes in Washington, D.C., I mean, the first thing to appreciate is logic is not the dominant factor in this discussion. This is not a discussion, unfortunately, about national interests, as though everybody sort of cloaks themselves in trying to solve our national dilemma of having too little income and too much debt. And it really takes a back seat to sort of ideological, personal, and special interests. So there are three key points that I want you to remember when you think about the future of tax reform in the United States. One, as brilliant as these two gentlemen are, tax policy reform in the United States is not a matter of policy, it's a matter of politics. We have way too many good ideas, way too many choices, way too many things we could steal from everyone else around the world who've done it much more effectively, like a VAT tax. So this is not a matter of policy, it's a matter of politics. And just like healthcare, you can keep doing more studies, more reports, and generating more ideas. It doesn't change what is the fundamental impediment to getting tax reform. Two is that as much as we all like to talk about unnecessary tax loopholes, if you don't like the oil and gas companies, getting depreciation allowances, if you don't think the solar credit was good for the country, you don't like farm subsidies, you don't like other things that help major corporations, you need to understand that one person's loophole is another person's income. And so behind every one of these policy are people who personally and in terms of their company are making money. And when people are making money doing things, they fight really hard when you try to take it away from them. And Washington is littered with people on K Street whose entire job is to make sure that their company's special benefit never changes, even if it's better for the country, but not if it's not better for the company. And so one person's loophole is another person's income. And the last thing I want to say is, in Washington, D.C., when you don't get your own way, as opposed to in other parts of life, where you say, well, I'm going to find my second best idea to get something done. In Washington, D.C., everyone's second choice is to do nothing. So if I don't get my way, I make sure no one else gets their way. And that is Washington's default decision. And creating a way to overcome that hurdle is really the problem. So first, let me also then talk about the two discussions that are going on in Washington that we're discussing here. The first issue revolves around what I call the suicide bomber moment of tax reform, which is as a result of the Bush tax cuts, where we manipulated the real cost by having them end after 10 years from accounting practices in Washington, D.C. When we have a debt ceiling about to occur, which we have to raise if we want to continue to pay our bills, and where we have a self-imposed, what's called sequestration, which is if you don't do certain things, automatic cuts will go through. We have like strapped dynamite onto our body and are threatening to blow up the entire U.S. economy if we don't act. And people did that by choice. because they realized that up to now, we can't act by decisive, thoughtful, rational thinking, so let's strike dynamite to all of our bodies and see if we can blow ourselves up. And so we're about to have a suicide moment in Washington, D.C. And where you might think that the number one choice then would be to do something, I think you're going to find the number one choice is to do what in Washington, D.C. terms do nothing, which is you do something very small to defuse the detonation of the bomb. You kick the decision 6 months or a year down the road because you believe that somehow time is going to solve the problem. And then you hope that miraculously someone figures out an answer so we don't have to self-immolate ourselves at a later date. So we're in the suicide moment. Everybody thinks it's going to cause change. I think it's just going to cause everyone's favorite rule number 3, second choice, kick it down the road. The second issue going on in Washington, D.C. is kind of worshiping the Simpson Balls Commission. And so, in case you don't read about it, the media, as Bloomberg has said, has elevated the Simpson Balls Commission to benchmark status. So if you're not for Simpson Balls, you're not serious about deficit reduction, you're not serious about tax reform. It is the kind of benchmark against which people's behavior is judged. So it is no surprise that John Boehner has called Simpson Balls a menu that he has followed. Mitt Romney has said he's conceptually tailored his tax proposals in line with Simpson Balls. President Obama has spoken approvingly of it. Nancy Pelosi praises his fiscal formula. Mitch McConnell says he hails its discipline. The gang of six senators have organized 40-something senators to be for Simpson Balls. Now the business community, Dave Cody from Honeywell has organized a group, and Sam Nunn and Senator Gregg are now involved. They've raised $25 million. Everybody's for Simpson Balls, except Simpson Balls is something different to every single person. And this is where the dead end that was talked about by Michael occurs, that we're all for it, except what it is not the same thing to everyone. But that is kind of the ground zero of the discussion. So let me just explain what Simpson Balls was, what it says about tax reform. First of all, it's important to understand, and Michael here talked about this, that Simpson Balls did something really important, which it said that all of these, quote, tax expenditures, mortgage deduction, retirement protection, earned income tax credit, all of these things are actually not tax expenditures. They're spending through the tax code. And conservatives like to cut spending. They don't like to raise revenue. So when you're cutting spending through the tax code, all of a sudden we found this great convergence of discussion because we're cutting spending. So we're cutting spending in some ways for tax loopholes that Democrats want to get rid of. Grover Norquist says that cutting tax expenditures is not a violation of the tax pledge as long as it doesn't raise money, so he's more than willing to let people fool around with it. But if you think about earmarks, which has occupied a lot of time in Washington, D.C., everybody talks about we have to end the earmarks. Earmarks cost $16 billion a year. Tax expenditures, as Michael said, are $1.1 trillion a year. And so people like to fool around with tax expenditures because there's no big corporations, there's no big oil companies, there's no rich individuals involved. It's just Congress people trying to get some money into their home district. And so we talk a lot about earmarks, which really relatively have no money attached to them, and sort of avoid the tougher issues of annual tax earmarks or tax expenditures of $1.1 trillion. So Simpson Balls did a very simple thing. It said, let's imagine a tax system where there are no deductions. Right? You don't get a deduction for your home, you for charitable contributions, for anything. So the baseline is no tax expenditures, no deductions on your income tax, basically 3 flat rates. And so they said if you zero out all the tax expenditures, you can reduce the income tax for people up to $70,000 to 8%, for people up to $210,000 to 14%, and for people over $210,000 to as much money as they make, up to 23%. Dramatic reductions in the tax. And then they said, and this was the Simpson Balls as opposed to tax reform, we want to get $80 billion, so whatever we do has to raise $80 billion, and that 8, 14, and 23% would raise $80 billion if we eliminated all of these tax expenditures, these deductions that most people like and change. And then they said, if you want any of these tax deductions, like you think people should have a home mortgage deduction, or you think people should have an earned income deduction, then you have to raise the rates. So if the rates are 8, 14, and 23, and you put back certain deductions, then the rates have to go up. So it's a very logical, thoughtful way to think about it. And it was a very important discussion because people now talk about cutting spending in the tax code, broadening the base to lower the rates. And then Simpson Balls made its decision about which were their favorite tax deductions. They said, we want to keep the earned income tax credit, the child care credit, the mortgage interest, the employer-paid health insurance, charitable giving, retirement savings, and pension. Which meant that all of a sudden their 8% went to 12%, their 14 went to 22, and their 23 went to 24. The corporate rate, which they had placed at 24, went to 26. But it's like a game. You could actually create, in fact, people have created the game. Go to 0, out all the tax deductions, and add back in what you think are the right public policies or the right political policies, and then we will figure out what the ultimate rate has to be. It is so logical that it will never work, because behind every deduction is huge constituencies. People like myself who like my home mortgage deduction. People like myself who believe that people that work every day and don't make a lot of money should get a child tax credit or an earned income tax credit. These are not necessarily bad public policies that we've adopted. It just means that once we start the debate about which ones, we will get to Washington's rule number 3, which is do nothing. Because I'm not going to get the ones that I want, and you're not going to get the ones that you want, so we should do nothing. And that's kind of, unfortunately, where we are. And to quote a guy named John Farrell from the National Journal, the reason Simpson Balls won't work is because it's going to hurt. Because the devil's rage in its details. And his original core report, Simpson Balls, calls for the elimination of coveted special interest tax breaks and subsidies for Washington's most powerful and deep-pocketed lobbies: oil, pharmaceuticals, finance, defense, healthcare, insurance, and real estate, just to name a few. Conservatives hate it. The Heritage Foundation, the Americans for Tax Reform, don't like the tax policy. Center for American Progress, Center for Budget Policies hate the changes in Medicare and Social Security. So everybody likes Simpson Balls. You have to say you believe in Simpson Balls, and nothing will happen with Simpson Balls because it's far too big and far too complicated, and it builds on the 1986 theory, which probably is not the theory of change going forward. And the only two changes I can see happening here is, one is to tinker with the deductions. And by that I mean take the mortgage interest deduction. Some people say, well, we should keep it, but let's cap it at $500,000 maximum deduction. Some people say we should keep it, but only on a principal home, not on a second home. Some people say we should phase it out after $250,000. There may be a way to tinker with existing deductions to try to make them more equitable. And the second thing that has some chance of happening, because it allows people to keep in place their most favorite deductions, is you cap the deductions. So you say, we're going to keep all the deductions, but you can't take more than 28% of your income, or 28% of deductions of your income, or 15% or 10% or whatever it's going to be. Because then we leave a ridiculous structure in place, which everybody doesn't have their axe for, but we cap the utilization of it. In the end, the interesting thing about Simpson Balls is everybody agrees with Michael Graetz. Everybody thinks the most logical, thoughtful, effective, efficient, and many of the characteristics Mihir said is to go to a consumption tax. Every other country in the world doesn't. It works. Very importantly, as Michael said, a tax imports but not exports. Many people pay for their healthcare system through VAT taxes because they're taxing the goods coming in, which help contribute to the country's finances. We don't. And so we are the last country in the civilized world. I think we're joined by one country in Eastern Europe and one country in Africa now that don't have some kind of consumption tax. I just want to end by adding two other consumption taxes that I think have possibilities to consider that really have not yet sort of gotten as much traction practically, well, had some traction practically in the case of one, and I think is going to gain traction in the case of the other. They're just different kinds of consumption tax. First is the carbon tax. There was a time in history when this was a bipartisan idea. The American Enterprise Institute, Greg Mankiw, who's a big Republican conservative economist, the Pete Peterson Foundation, and a proposal they put forward to about how they would cure the deficit problem, all have a carbon tax. Carbon tax has lots of advantages. It's about consuming something that's bad, which is carbon, getting that out of the Earth's atmosphere, and it serves a lot of purposes. It can be done. There are lots of issues that, as Michael has figured out in the VAT tax, about how to make it progressive so that lower income people don't have energy costs rise significantly. And the second consumption tax is the consumption of financial services. So around in Europe right now, there is a discussion amongst 10 European countries in the EU about what's called a Tobin tax or a financial transaction tax. And that means we are going to put a very small tax on financial transactions. Stock transfers, purchase of stock, sales of stock, other kinds of financial transactions. Because so much money is involved, a very small tax produces a very high amount of income. A lot of people don't like it for certain reasons. Some people say only some countries adopt it and others don't, and it put those stock markets or those countries at a disadvantage. I think it's important to appreciate that Europe is having a very serious discussion about, from Germany to the UK to France, about adopting a financial transaction consumption tax, and I think that's very much. The bottom line is we have to do something in the sense that our country is in a place internationally, as Mihir said, where we are outliers. We have a tax system that's not competitive, not effective, not efficient. Doesn't make any sense to people. People think that some people are taking advantage of the tax system, and as Mitt Romney has proven, that's true. And what we need to do is do something. But up against that is Washington's favorite second choice, which is to do nothing, and that's the political challenge.
Any comments from the other speakers about what you just said? I have a couple of questions if I can kick this off. We want to go to the audience for your questions. But my observation, I was a tax lawyer for part of my career, my observation is that there is so much interest in the tax law from what it means to me, and I say that means on the corporate side, individuals and everybody else, that it's inherently unstable to some degree. So you come up with a good idea, you get it implemented, but then the law starts to get pressure from others to change it, to modify it, to sell either an economic purpose or a motivational purpose. How do we overcome that? Because all of you have good ideas about what we need to do. How do we get this thing into a format that solves the government's problems of equity, revenue raising, but becomes stable and doesn't get modified down the road and off back into some other problem? Is that possible? I guess is my question.
Well, I would say the fat lady never sings in tax politics or policy. So, no, it's not going to be stable. But one of the things that's interesting is that there are certain things that can move easier than other things. And so you have to structure your tax reform in a way that will keep it from coming undone in some fundamental way. So just to take 2 points that have been raised. One is Mihir's idea of taxing the large partnerships and subchapter S corporations, the non-corporate businesses as corporations. I think this is extremely difficult politically. One might even argue that you're imposing a bad tax on people who are now, through self-help, able to avoid it. It's become a big problem because it used to be that if you needed a large amount of capital, you had to go to the public capital markets to get it. And in order to do that, you had to be a corporation. But now, with the existence of sovereign wealth funds and private equity, you can get very large amounts of capital into a business that is not a corporation and is not taxed as a corporation. This is a relatively recent phenomenon. If you put those companies over a certain size, $50 million of sales, into the corporate tax, it's going to be very hard to get them out of the corporate tax. It's going to be as hard to get them out as it is to get them in at the moment. Now, I have some concern about the political ease of getting them in, but as Andy says, none of this is easy politically. The same thing is true of the way I've structured my proposal. which is to create an exemption of $100,000 indexed for inflation, I should emphasize, from the income tax and remove 150 million people from the income tax. Nobody's going to stand up on the floor of Congress and say, let's bring those people back into the income tax. It's just not going to happen. It didn't happen until the Second World War, when the income tax was extended to the masses, and we were that close in the 1940s of having a consumption tax extended to the masses instead of the income tax, in which case we'd have a very different conversation. The same thing is true, by the way, I think, and I think this is really overlooked in terms of the relationship of policy and politics. Infrastructure is extremely important, so that, just to take an example that Andy knows well, the creation of health insurance exchanges so that individuals can buy health insurance through a group and spread risks, which is an important part of the Health Act, is a huge change in terms of the underlying infrastructure of how people get health insurance in the U.S. And so today, individuals who are working can only get it through their employers. Once that infrastructure changes, then the system will move. And so I think that the answer is no, the tax policy is never going to be stable. You're going to have surpluses one year and deficits another year. You're going to have Republicans controlling the government one year and Democrats another, or divided government, so it's always going to change. But I do think structural issues are extremely, extremely important. And then I guess the other thing I would emphasize is something that Mihir says, which is that the pressure on business taxation from the globalization of the economy is something that's just beginning to be felt and just beginning to be recognized in tax policy and tax political circles. The U.S. has just been in denial about competition and the movement of capital. And where we're really taking a beating today, which I would emphasize, is on the transfer of intellectual property. Because the incentives now under the U.S. tax system are that if you move your intellectual property abroad, you can save huge amounts of taxes because we've got such a high corporate tax rate, and all you care about is what is the statutory rate on that income, and Europe has gone to very low. And when I say very low, I mean 5 to 10% statutory rates on that income. And then we have a set of rules that say, well, in order to get that, you better move some manufacturing over there as well. Right? So this is a huge structural problem. And that's the way I think you can think about creating some stability in the system. And that's, I think, the only way. And I guess the one other thing I would say is that I think Andy and I are in agreement that the U.S. really needs another revenue source. That we cannot rely, as we have for the last 100 years, on income taxes alone, or income and payroll taxes, to finance our spending. And I think Andy, despite his disclaimers about being in a room with people who know more about taxes than he does, has put on the table the other two options. That is, there are three alternatives for finding significant amounts of revenue. There is a broad-based consumption tax. There is an energy tax of some sort, which a carbon tax, given the concern about greenhouse gases and global warming, is the front runner. But there are others. Bill Clinton, for example, proposed a BTU tax. The 1990 budget negotiations came very close to having an energy tax. And the other is some tax on financial transactions. And it turns out that the latter, unlike the first two, is just extremely popular politically. I mean, if you want to talk about politics, I had some conversations with the head of the European Commission, and it turns out that the polling data shows that 60 or 70%, depending on which polls you read, of the European people favor taxing financial transactions, securities transactions. Now, why do they do that? Well, again, they assume it's a tax on somebody else, and they'll never see it, and they'll never pay it. But of course, might pay it. It's not going to be paid, out of thin air. It's got to be paid by somebody. But it's extremely popular politically. And I think it is the case that if you can get enough financial centers to impose such a tax at a low rate, and by a low rate, Harkin has proposed 3 basis points, which is, very, very small. 10 basis points has been talked about. There's real money in it. There's real money in it because of the volume of financial transactions that's now taking place. And that was another idea that was actually on the table in the 90 Budget Act. It was not discussed much, but we talked about it a lot. It just didn't happen. And then the question is, what are you going to do with that money if you get one of those taxes? And then, some people want to use it to finance health insurance. Some people want to use it to lower the debt. Some people want to use it for tax reform. But I think we've got all of the issues now on the table.
Let me just add 2 quick points. First, I think Michael's right to kind of say that Andy's put on the table 2 very interesting ideas. Carbon tax, which I think I completely support. For 2 obvious reasons. It approximates the consumption tax, gets us towards that. There's real revenue there, and of course it corrects with externality, and you pointed out too. The transaction tax and utility tax, I think it's an interesting idea. I think it's worthwhile emphasizing 2 things. One is, it's not on the order of magnitude of a carbon tax in terms of revenue or in terms of the scope. So, and I think it is going to be politically motivated. That's number 1. Number 2, in Europe, it's often combined with the discussion of bank taxes and financial institution taxes generally. And that's where I run into a bit of a problem. Because I think that's where more money is, and that's where the political action is. But we are falling over ourselves, pouring money into banks in various ways. We're trying to recapitalize them all around the world. And that's obviously across the re-equitization of these financial institutions is something we're doing in stealth ways. Effectively, for the last 3 or 4 years in stealth ways, is trying to re-equitize these things. And then to kind of, at the same time, with the other hand, take them out of them, is something that I find a hard logic to make sense. Another point I just wanted to make was on the politics. Jesse, you asked about what can lead to stable systems, and I think Michael's right to suggest that that's not necessarily the goal. It would be okay to renew our system, as Jefferson suggested, every once in a while, and that would be just fine. I think what's harder to figure out is the political logic that would get us to do something. Andy laid down like a remarkably depressing set of facts, which I think are roughly right. But I think there's actually a ray of sunshine in the following sense, which is I think there are probably 3 theories of tax reform. More kind of ideas out there. The first theory is the crisis theory. So if you're Greece, you undertake tax reform. It happens. And if you think about the adoption of VATs around the world, it was often led by IMF missions that went in there and did those things. So that's the crisis theory. That's not a very attractive theory for us to pursue. It's just not. It could happen, but it's not an attractive theory for us to pursue. The second theory is kind of the stars in alignment theory. There's just this kind of combination of the stars alignment and the third version, which is kind of the usually great man, great person theory. Which is it was Rostenkowski and Packwood, and they got in there and they got in the room and they got it all figured out, and that's what leads to these things. None of those show much sign of happening. So I have taken Simpson Bowles, the reaction to Simpson Bowles, as heartening. Now you might say, well, it's all tabula rasa, people see it there, whatever they want to see, and so whatever. But the level of discussion we're having today about these issues relative to a year or 2 years ago, I take solace from that. I take that to be progress. So I understand, perhaps I just cannot fall off the existential cliff that Andy, I think you may have fallen on, which is do nothing prevails. I actually see some rays of sunshine.
Yeah, I would say I'm a do nothing if we wait for Washington to solve the problem person. If you think about how healthcare was solved, it was solved because lots of people outside of Washington, companies, workers, advocates, came together and created an environment in which you thought they had support to act from many different places. So to me, the question of what people do outside of Washington, not in the traditional, Barack Obama, you are the change, but more in the terms of, can the forces that are affected by this make a deal or make some principles, I think is the potential solution. I would just say two things. The underlying problem with all of this is there is a discussion that doesn't happen, and that's about how much revenue the country needs to operate. So at one time we were spending on average 19 to 21% of GDP, or was what the government spent. It dropped dramatically during the 2008, I think down to 14% for a while. It's now up to about 17, I think. For a while on revenue. We're spending on 23 or 24, but the revenue. So then the conservatives say we kind of like we don't like where the expenditures are, but this revenue is perfect. If we could just now cut everything down to 17%, life would be beautiful. And the progressives say if we could get everything up to 24%, life would be beautiful. And what Simpson Balls did, to its credit, which I think is part of the solution, is they agreed upon a number, which was like 21%. That was the number that they felt. Because the opposition, despite the fact that Paul Ryan in private will tell you that he believes in Michael Graetz's plan. I can say that, there's no press here, but it's true. That he will tell you in private, except he thinks all the Republicans talk about, this is their exact language, we're putting a third engine on the power boat. Right? We have an income tax, we have a corporate tax, now we're putting a third engine on the power boat of the government, and the government will just speed away and spend more money. It won't. So unless they say we could pass a constitutional amendment to limit spending, we're not going to give the government a third motor on the boat. But we have to figure out that dilemma, because it's actually not the vehicle, it's not the engine they're worried about. It's like, where is the engine powering the boat to? And they like the 17%, don't like the 24%, and don't want to give the tax and spend liberals the way to spend the money, to gain the money to spend.
So can I just make two more comments before you open it up to the public? One is, I think the revenue from a carbon tax, I proposed a carbon tax in the book I did on energy policy, in which, because I think it's better than cap and trade for any number of reasons, which I won't go into. But I don't think you should count on much revenue from it. In the first place, the base is about a quarter of the value-added tax base, and it's much more regressive than consumption generally. So you have to give back at least half the revenue. You probably have to give back more. And then we've got the coal industry. And the reason cap and trade failed is that the coal industry succeeded. And it succeeded not just because of the coal producers, West Virginia, Pennsylvania, Southern Illinois, and Indiana. It succeeded because the cheap electricity from coal. And so you might get a carbon tax, and the move from natural gas, from coal to natural gas, which is taking place now, is actually remarkably encouraging in that regard, because the oil and gas companies are actually pretty happy with the carbon tax, because it would accelerate that move. But there's not a lot of money in a carbon tax that's going to go either to deficit reduction or anything else, and I think we shouldn't kid ourselves about that. I think it's a good policy, but not much revenue. And then I guess I just want to, I feel like Ronald Reagan, in which everybody's piled up all this manure, and I'm looking for the pony, right? With this much manure, there has to be a pony somewhere. That's what Reagan said, and he's right. I mean, there has to be a pony somewhere. Look, I think we're going to need about 21% of revenue. It may be that Simpson Bowles 86 style tax reform is going to be everybody's idea until it craters, but it's going to crater for the reasons that we've just talked about. And once it craters, where do you go? And the population is aging. The CBO has projected that we'll have $20 trillion of federal debt owed to the public in 10 years. Under reasonably realistic assumptions. And if you think that by then interest rates are 5%, that's $1 trillion a year in interest on the federal debt. And that is the most important change in the federal finances that has occurred in the last 5 years. of anything. People talk about health costs, aging of the population. It is interest on the federal debt, which has changed dramatically. And, you know, we're going to have to pay that. You can't, you know, even Paul Ryan doesn't know how not to pay the interest on the federal debt. And so we're going to have to pay it, no matter who's in office. And that means we're going to have more revenue. And so there's going to be a moment, and the question is, either one of two things is going to happen. Either someone, and I watched George Bush Sr. do this. I was in the room when he said, this may cost me my election, but we have to raise taxes. And it did cost him his re-election, and he did raise taxes. But somebody will do that at some point, I believe, because I'm optimistic. And or a second-term president may be able to do things that a first-term president can't. Reagan did tax reform in his second term. Or the markets or some combination is going to tell us we have to have another revenue source. And then the question is, how does it come out of a meeting with nobody being responsible for it? And when that happens, I think it will happen. But that can happen. That's happened many times in the past when no one knows exactly who to blame. And it may be a, you know, Nixon goes to China moment, or George Herbert Walker Bush gives up his no new taxes pledge. But, you know, we can't. The status quo is not possible. And I just don't think that the kinds of haircuts on the tax expenditures that you're talking about, you know, we're going to cap all tax expenditures. Sounds a lot like an alternative minimum tax to me. You know, or we're going to, you know, we're going to give up corporate jets, second homes, and, you know, Congress is going to be reluctant to give up second homes since that's how it got in there in the first place. They have most of them. You know, and we're going to stop at $500,000. I mean, this is chump change. This is chump change. And so I don't think you can get there from here without doing something big. And so I think it's inevitable. Now, you know, call me an optimist.
Let me close by thanking Richard Richman, who's sitting up next to Chris Mayer, for his sponsorship and creation of the Richman Center and making discussions like this possible. They all help us a lot to understand these complex issues. I'd like to thank the Richman Center staff, Kathleen Vithithorn, for her support of my operation here in this lecture. And I'd like to thank our guests, Andy Stern, Mihir Desai, and Michael Graetz, for their discussion today in depth on these very important topics. So thank you all. Our next lecture will be October 2nd, and we'll have Peter Orzak from Citigroup here to talk about the fiscal cliff and what happens if we go off.